Good morning, everybody, and welcome to this morning's webinar. I'm Jaco Brandt, I'll be your host. I'm joined by Raymond Shapiro, who is the lead portfolio manager of the quality strategy within Counterpoint. As most of you know by now, Counterpoint is a multi-strategy investment business, boutique asset manager, and within Counterpoint, we currently host 5 strategies. We've got the fixed income strategy, payers and growers, the multi-asset strategy, which sits under the Quantamental core, the value strategy, and then, of course, quality that we will be discussing in a bit more detail today. So within the quality franchise, we currently host strategy. We've got 2 portfolios run by Raymond, the Dividend Equity Fund, which is a local general equity fund with some offshore exposure, and then the Global Equity Fund that we have available in a dollar-denominated portfolio as well as in a feeder fund. So just before I hand over to Raymond, just some housekeeping as usual. We use GoToWebinar as a platform to host these webinars. The first thing that usually goes is your sound when you've got bandwidth issues. So for the best possible or quality experience, please close down all applications that are, that you won't be using during the next hour or so. That'll definitely provide you with the best possible experience. Then the question we get most often is, do we get CPD points for these sessions? We definitely apply for CPD points from the FBI. It takes us about 2 weeks to get them approved, if we do get them approved. And we then send out those CPD certificates automatically to all people that were in attendance and that do qualify for those certificates and that indicated that they wanted them. Then, very importantly, we do have a questions box. You'll see in your navigation pane that there's a place where you can actually post some questions. We will have a few minutes at the end. I know that quite a few of you posted some questions during registration. Thank you for that. I know Raymond will speak to some of them. But if you do have questions on the live session, please do pose that to us, and we will try and get to them. If we can't get to them during the live session, we will certainly get back to you post the close of the session. And then, as always, we've got the survey at the end. If you don't mind, please take a minute. It's not going to take more than a minute of your time to please provide us with your feedback in the survey. We really do appreciate it, and it certainly helps us to improve these sessions as we go along. So Raymond, just before I hand over to you, if you can maybe just go to the next slide. We did pose a question, while we were preparing for today's webinar. Raymond and I thought, well, let's ask a question of the audience before we get into it. And seeing to that we're talking quality today, we wanted to pose the question to the audience. If you had to categorize your offshore exposure, where would it fit? And of the 179 responses that we had 42 blanks or no responses. This is what the outcome looked like. So 42 out of the 179 people that responded already has exposure to quality in a global context, 38 value, 61 growth, and I think that speaks to what transpired in the last decade or so. I think that's pretty much where large degree of the opportunity sat. Then 22 out of the 179 sat in other or general, and 16 in passive. So I think Raymond has got a good opportunity to convince quite a bit of the audience today that quality is probably the place to be in a global context. And so thank you for your responses. I hope you enjoyed that bit of feedback. Raymond, if you can take us through today's session, please.
Thank you, Jaco. Very, very interesting results. I think it's always fascinating to see how people are allocating money across styles. This morning's presentation I'm going to concentrate on just digging a little bit deeper into what quality is and how it works, and in fact, if it works. So moving on to the next slide. This is really our overarching philosophy in Counterpoint, in the Counterpoint quality stable. And this is how we kind of approach things and the mindset with which we approach them. And the first and most important point is compounding over long periods is the most powerful force in investing. I think I don't have to tell anyone listening, but I'm constantly astounded by the power of compounding, even though I've dealt with it every day for almost 20 years. It never ceases to amaze me, and we're going to see as this presentation goes on. I think it's going to continue to amaze the power of compounding. our view is that great businesses compound returns at higher rates and for longer periods. So it's not just a matter of the end investment, thinking about end investments compounding or shares compounding. It's that compounding is caused by something else, and what we believe it's the rate at which businesses compound their returns internally. So what they invest versus the profits they make, the return, what we would term as the return on capital. What's pretty clear to me is that investors continually underestimate compounding and they undervalue quality businesses. Given that our goal is to capture these returns from compounding by selecting and patiently holding high quality growing businesses. It doesn't mean they have to be the highest growing, but we do believe that growth is a sign of health. And as important to that is continuing to hold businesses, getting in and out, trying to time the market or get in and out of different investments really breaks the compounding chain, which destroys your returns. And as always, investments really need to be made at sensible valuations to facilitate attractive returns. But of course, there are different things have different value, and we think quality is undervalued, mostly, as I said, because people underestimate the power of quality and its ability to compound. At the end of the day, what is quality and what does it do? Quality endures. It endures and it thrives, but to do that you first have to survive. And I think one of the hallmarks of a quality company is that it survives long periods of time. It's not a fly-by-night business. So how do we define quality? As I mentioned, our approach is to buy the best companies at the best prices. But what is a quality business? The hallmark of a quality business is really that it generates sustainably high returns on capital. So that means the profits, the cash profits it makes on the capital it invests in its business is high. So for instance, a 30% or 40% return on its capital invested is a good return, and generally speaking, a single-digit return is a bad return. So businesses can sustainably generate high returns on capital over time. I would term as a quality business if I were to just use one single metric, and empirical studies have shown that this is in fact the most powerful metric in terms of providing lucrative returns long term. We look for a long-term track record of value creation. So of course it's hard to just take one data point and say something's quality. I think that it makes common sense that we need to look at track record, and we are really sticklers for track record. An attractive product proposition with a robust business model. So understanding how the business makes money, and if it's selling a product or service that the end customer actually wants and will continue to want into the future. And we spend a lot of time thinking about the products and services businesses sell and how valuable they are to the end customer. So we really strive to think like business people. Of course, defendable competitive strengths are incredibly important. I mean, some people call these moats. So if someone can easily replicate what you're doing, you're quickly going to get, your margins are going to get compressed, and you're going to get your advantages competed away. However, if you have defendable competitive strengths that cannot be easily replicated, this gives you pricing power, which, as we're seeing, is especially important in an environment of inflation. You need to be able to raise your prices if your input costs are increasing. Another hallmark of a quality company is that it's able to predictably grow cash profits well into the future, and I stress cash. The ability to convert earnings into cash is massively important, and is in fact the second most important element of quality investing empirically. So the ability to convert earnings into cash and not have to reinvest everything back into the business to simply stand still is an important principle. And growth, I really believe growth is health. It doesn't, as I said, it doesn't mean you have to grow at the highest rate, but if you're not growing at some rate, chances are you're dying. Management is, of course, critically important. I mean, management in many ways creates all of these other factors. So you want management to be aligned, you want them to have a long-term vision, and of course you want them to be highly competent. as we've seen over the last 2 years, being adaptable is an extremely underrated quality. So, and we've seen that companies that do well over time, they're extremely adaptable and they have a control over their own destiny. So, companies that are victims of the vicissitudes of the economic cycle, those are likely to be a lower quality. Doesn't mean that cyclical companies can't be quality, but you want companies that have control over their own destiny. Another interesting element is this use of debt financing. So a lot of people out there would say that the debt is really a quality metric. I differ slightly on it. I think it is definitely an input into quality. But I think the use of some financial leverage can help. But if you are overgeared, you basically increase the risk profile of the business. But it doesn't necessarily mean that the core business is low quality. It just means that you've increased the risk profile. And interestingly, empirical studies have shown that the capital structure of the business in terms of how much debt it uses isn't necessarily a predictor of future returns. However, it does increase risk, and that has to be taken into account. We look for companies that use debt financing sensibly and don't put the long-term survival of the business at risk. So if I were to kind of put it into a picture, whenever we invest, we are weighing things against each other. The core of what we do, that middle pole is really, we want a quality business, and then we balance the value of that business against the growth prospects of the business. So where does quality fit in? In looking at a company, I've put these two blocks on top of each other, and I think as some of you, it might look familiar to some of you attended some of our value franchise presentations. A business at its core, it has a certain amount of capital which are invested in assets. I say net assets because there's obviously working capital in there, and there might be some debt in there that finances assets. But at the end of the day, there's capital invested. That capital generates profits. I put their current profits because growth in profits is in fact another element, and then those profits can grow into the future. Now, value investing really focuses on the capital that's invested in the business and the current profits. So, as I mentioned in the heading, is to what driver do we ascribe most value? So value investing will focus on valuing the capital and the current profits of the business, and it doesn't want to pay too much for the current profits, and it definitely doesn't want to pay for growth. Current profits as a percentage of capital is really return on capital. So that is the productiveness of the business. And quality investing really focuses on investing in businesses with high returns on capital. Businesses that are extremely productive and efficient in terms of generating profit off their capital base. So that is what quality investing focuses on, those businesses. Now, what do we do with current profits? We've got these profits, and we can do something with them. Either we're going to pay them out as dividends, and this is where dividend investing comes in. So dividend investing will focus on companies that pay dividends. Dividend investing can also be linked to quality investing. Of course, companies that are extremely productive in generating profits can pay higher dividends. So this is one of the reasons we include our dividend investing approach under quality, because we look for quality companies that pay dividends because they are able to. Or instead of paying dividends, the company can retain its profits and invest it back into the company to grow the business. So they can reinvest profits into the business to grow. Now, the growth equation is really how much you reinvest in the business multiplied by your return on capital. So we can see already in growth, there is already a link to quality investing, because return on capital is an extremely important input into growth. And of course, growth investing focuses on growing businesses and is willing to pay for that growth. Obviously, paying for all of the growth or paying for more growth than actually happens is the risk around growth investing. But of course, if you can pay for only half the growth and the other half comes through, you're going to make good returns. So quality investing, as you'll see, it's kind of encroaching on growth. So quality investing does focus on return on capital, current profits, but it also looks at growth, because that is an important input into both quality and valuation. So where quality fits in and who invests in quality is really about where you decide to ascribe the most value. And we're going to move on to other elements which I'll show. Quality investing, there's almost a hidden compounding element in the style of quality investing. So how does quality work? I call it compounding on steroids. There's the return on capital flywheel. It powers both growth and dividends. So let's start with a simple example. We have a factory. So this factory we will call Factory A. This factory, to build this factory, one had to invest 1,000 Rand. From that 1,000 Rand, we could generate 100 Rand in profit. So that is a 10% return on capital. With that profit, we have some decisions to make. What can we do with it? We can pay ourselves out a dividend. Let's assume we have a 30% dividend payout ratio, so we have 30 Rand. With the other 70 Rand, we can invest in the business, reinvest. But we're reinvesting at 10%. So we make a further 7 Rand return from growth. So that reinvestment could be represented graphically by putting it back into the business. So we can see there's a cycle here of reinvesting into the business. But our return from that reinvestment, at least from the first year's profits, is only 7 Rand. Now we have another business. This business, we only invested 250 Rand in building this factory. However, the factory has a 40% return on capital. So it can also generate 100 Rand in profits. Notice that the profits of these two businesses is the same, but the capital invested is less. It's 1/4 of the capital invested, yet we're generating the same amount of profit. Now we have the same decision to make. We're going to pay out 30% as a dividend. Okay, so we've got the same dividends, but we had a much lower investment from only 250 Rand. We had to invest to get 30 Rand. Previously, it was 1,000 to get 30 Rand. Now we've got our 70 bucks, and we're going to reinvest it in the business. And here's where some of the magic of compounding comes in. We reinvested our 70 Rand at 40%, because the return on capital is 40%, is 4 times the previous factory. We now have a 28 Rand so-called growth return. So that reinvestment generated 28 Rand as opposed to 7. So the question is, this flywheel, we can see it's a flywheel approach. These two businesses, they earn the same profits. So maybe we could say, well, I'm going to pay 10 times earnings for each. I'm going to pay 1,000 for each. But they earn the same profits, but would you pay the same for each? Well, of course, you would not pay the same for each, because the one is if you reinvest, you're making 28 Rand versus 7. So clearly, the one business is worth quite substantially more than the other. And why is that? Because it's return on capital, and the reinvestment of that is generating a far greater return. Of course, we could choose to invest less and pay a greater dividend, but either way, you're going to make more money on a lower investment from factory B than A. And in a nutshell, this is really how quality works. It's this flywheel. And remember, the 28 Rand you reinvest in the business, and that itself will continue to earn a return. The 28 Rand can then earn another 40% return on 28. And I'll quickly do some mental arithmetic. It's probably about 11 Rand. And then that 11 Rand can be reinvested at 40%. And as you can see, this flywheel just goes on and on and on. And that is really the power of a quality business. It's the high return on capital. So with that, let's look at real world facts. Let's look at the numbers. So what I've got here are some indices of the last 5 years. $100 invested over the last 5 years in the MSCI World Index, the Value Index, the Quality Index, and the Growth Index. So these are fundamental indices, or some would call them maybe a bit of smart beta, but they're rules-based indices. And the quality MSCI quality indices, there are many of these indices. I'm just using the MSCI World that work on different quality metrics, but the MSCI ones in terms of quality really concentrate on return on capital, and they also look at leverage, and they look at earning stability. But return on capital is the most important. The value index looks at price to book. It looks at price earnings ratios, and in fact also looks at dividend yields as well. And the growth index looks at a combination of historic earnings growth and consensus forecast earnings growth. So those are, but many indices cover many different things. And in terms, one really does have to read it what they're focusing on. But I think they are broadly representative of the most important metrics in each style. Now we can see the last 5 years, growth had a great run, and however, despite that, we can see that quality kept up pretty well. They both handsomely outperformed the MSCI World Index, and as we know, value has had a tough time the last 5 years. But of course, 5 years is a shorter term time period. So let's look at 10 years. 10 years, quality has again kept pace, has outperformed growth, but growth is nipping on its heels. Value has underperformed for the last 10 years, and the MSCI World is somewhere in between. We do know that growth has had a hell of a run, yet quality has still managed to outperform growth. Let's look a little bit longer, 20 years. Now this is where quality starts coming to the fore. Quality has outperformed since 2002, outperformed growth, the world, and value. Now the interesting thing is in this table I'm presenting, we can see that the annualized return of quality has 9.5%, so it's almost double digits, and we can see how that is compounded quite handsomely. It gives you $647. But the interesting part is that the volatility, not only is it outperformed over 20 years, the volatility is lower. The maximum drawdown is low. I must apologize here, I've forgotten some minuses. So these are all minus numbers. So the maximum drawdown, it should be minus 47, minus 61, minus 54, and minus 57. I think that we can guess where that happened in COVID. And then I put a Sortino ratio. Sortino ratio is just a measure of risk return, but it focuses on only downside risk. I don't think we're too concerned about volatility that shoots up. That kind of volatility we like, but we can see how powerful quality is. The higher the ratio, the better. It's literally got more than double the Sortino ratio of value or the world. So it's got a very good risk return profile. But I'm going to put up another chart now, which is, I go back to 1990, and I think it illustrates the power of compounding. So it's 32 years of data. Now, I must say I was pretty astounded by this chart. I went and checked, is this right? Quality over 32 years, this is where the power of compounding is just on absolute steroids. It is significantly outperformed just about every other style and the MSCI World. At first I thought, okay, wait a minute, maybe it's just front end loaded. So I cut it in half, and I took the first 16 out of 32 years. And yes, quality did outperform the first 16 years, but it also outperformed the second 16 years. And we can see that just the power of compounding, of continual outperformance over a long period, really just mushrooms. So that's I think this is really an astounding chart. Quality doesn't just work, it really works. What I did then was say, okay, well, not everyone has a 32-year time horizon, and or even a 20-year time horizon. Often we're put under 5-year pressure. So I looked at 5-year rolling returns going back 32 years. So the kind of beigey orange line is quality, and we can see that quality really keeps up under just about every scenario. It never really underperforms the MSCI World. There are times, for instance, you can see the black line is value. Value did have a good run in terms of rolling 5-year returns in the kind of early to mid 2000s. But quality has always kept up with the MSCI World. In fact, if I take 5-year rolling returns, the average 5-year rolling returns over the last 32 years for quality has been 11%. But what's really unbelievable is I said, what percent of the time, and these are rolling monthly returns, they're not rolling yearly returns, I roll 5-year returns every month. And on that basis, the MSCI Quality Index beats the MSCI World 86% of the time. I mean, that is an astounding beat rate, especially over 32 years, whereas value doesn't in fact beat it even half the time, and growth beats it over half the time. The average alpha in terms of that rolling 5-year period is 3.5%. I mean, I think anyone would gladly sign up for 3.5% alpha on average over 5-year rolling periods. Interestingly, the other returns on an average basis, there isn't really any alpha to be had, which really tells you that, as we can see, a value, there are periods where it does outperform, as there are periods where growth outperforms, but you have to time these periods. Quality is far less sensitive to having to time, even over 5-year rolling returns. And then I just put the negative, what percent of the time did each of these strategies deliver a negative 5-year compound annual growth rate? And interesting, the world is pretty close to 20% of the time you could get a negative return, whereas quality, again, as I mentioned earlier, quality does deliver superior returns at a lower risk, and a fewer percent of the time does it deliver a negative return, and its hit rate or its beat rate in terms of the MSCI World is incredibly high. Another interesting point is, this is work I got from GMO, is that quality is especially compelling during inflationary periods, which we know in the developed markets is what we're going through. So it does well during inflationary periods. Why is that? Is because quality companies have pricing power. They can maintain their margins. They also are generally much more asset light, so they don't have to replace assets at an inflated price in the future. But if you combine quality with value, so if you overlay a valuation discipline, you don't overpay for quality, it's even more powerful. And this is something that we really focus on doing. We don't just pay any price for quality. We do start with a universal quality company, and then we look for, can we buy the best, the cheapest of the best companies. So why does quality work? As we've said, high returns on capital are rocket fuel for compounding, and this is something that one can just not underestimate. Businesses with difficult to replicate strengths are able to thrive despite competition. So the hallmark of a quality company, the reason it can generate high returns on capital is 99 times out of 100 is that it has a competitive strength that is difficult to replicate. So the business can continue to thrive, it can continue to grow despite competition. It's resistant largely to competition. And this enables it to survive and thrive, which allows it to capture the power of compounding. So highly profitable companies can survive downturns, they can survive shocks, and they can survive threats. Survival is a critical element in compounding. Of course, you can't compound if you don't survive. So the ability of quality companies to endure also generates valuable business lessons. So as companies survive, they learn, and they put those learnings into practice, and they have the opportunity to generate various intangible assets. So it's not just building more stuff, it's things like brands, the culture of the company, and sound business systems. I think we can all understand from very successful franchise businesses such as McDonald's or Yum Brands, they have their secret is in their brand and in their system of operating, and you can only build that if you survive, and you can only survive if you have a moat and can generate sufficient returns on capital to buy that fuel for reinvestment. So there's a cycle of This return on capital, this endurance fuels a cycle of continuous improvement and value creation. So it's really about doing the right things. So doing the right things really snowballs, and it's that snowballing compounding effect that is the secret behind quality. So in terms of our investment principles and how we implement it at the Counterpoint quality franchises, we capture the returns from investing in great companies. So we first ask ourselves what companies do we want to look at, and then how much. We don't look for the cheapest and then try and buy the best. We first look at the best and have a universe, and then say how much. So we feel we're fishing where fish are. We focus on strong future fit business models. We believe growth is good, growth is health, but one has to be very careful about what one pays for that growth. And we spend a lot of time thinking about what will this company be worth and what position will it be in 5 to 10 years' time. And that forces you to take a longer-term view, which I can say by and large the market does not take a long-term view. The market is obsessed with yearly and quarterly and semi-annually earnings. We always factor a margin of safety into our valuation. And this is very important. One really has to manage risks. You can't one can't build portfolios for one outcome. So we have to diversify across things that we can't control. So we can't really predict when a COVID is going to happen, when a war is going to happen, or even, in fact, it's difficult to predict when an economic downturn is going to happen. So one has to diversify your stock picks. That's how you manage risk. And we need to adapt to the changing environment. I think what's very important is to open one's eyes and see what's happening in the real world, as opposed to what's happening on your screen or what's happening on your phone or what's happening, in the short-term market movements. We have to adapt to the changing environment, and we have to look through short-term conditions. I mean, who would have said that probably the best time to get into equities was the 1st of April 2020? Really, one has to look through short-term conditions and not panic every time some bad news comes out. So why invest in quality? It works. It's backed up by empirical and academic evidence. If anyone would like some of these papers, I mean, I've got a whole stack of papers that we can send to people. Investing in quality, it really rewards patience, and it requires fewer trading decisions. I think that one shouldn't underestimate this. If no one wants to make trading decisions every single day, I think the more decisions you make, the more likely you are to make a mistake. And quality is one of those approaches to investing that really rewards patience. There's a greatly reduced need to time correctly. So I think with value and growth investing, one really has to be quite sensitive as to when one is going to invest in growth companies or cheaply valued companies. And as we saw from those rolling 5-year returns, a significant percent of the time, it can be a 50-50 bet, whereas a greatly reduced need in terms of when to invest in, say, a quality fund. In addition to that, for the quality fund manager, in terms of buying quality shares, the shares themselves are often less sensitive to when you buy them. They are far more forgiving in terms of if you pay a little bit too much. In the long term, the return on capital makes up for that. Quality focuses really on business attributes. Value and growth investing are very much focused on estimates. So value, it's your estimate of value. Growth, it's your estimate of what something will grow in the future, whereas quality focuses on the business attributes now and, of course, in the future, but it first focuses on the returns on capital as they are currently. And now the lower risk nature of quality investing, it really reduces the tendency, and this in many ways is a behavioral thing. It reduces the tendency to make damaging changes to your portfolio or your group of portfolios, which then break the chain of compounding. So in many ways, it can protect you from yourself, which I think is an underrated quality. And we know quality, as we've seen from the numbers, it is in fact lower risk and lower volatility. So my firm view is that quality should be the long-term anchor holding in client portfolios. I mean, I will give my view on a percentage later, but it does depend on the client's end objectives and what kind of client, is. If a client's, got 1 year to retirement, I'm not saying put all your money in equities or quality equities. It's really dependent on the client. But I do believe that quality should be the long-term anchor holding and take us from whence it comes, but I think it should be the highest weighting. So just to finish up on some wise words, Buffett, probably the most famous quality investor who again does overlay valuation on his quality approach, is that, his goal is to find outstanding businesses at sensible prices, not mediocre businesses at bargain prices. And I can say I've learned from experience the way to damage returns. No one will overpay for a mediocre business. But it's when you see a mediocre business at a bargain price, that's when you make mistakes. I can say I've definitely learned that from practice. And time is really the friend of a wonderful business, as we've seen it. Wonderful businesses keep compounding, and that return snowballs. And Buffett's partner says a great company keeps working when you're not. The converse of that is a mediocre company, things go wrong, and you get nasty surprises. And at the end of the day, that's not really what we want, nor do end investors want nasty surprises. So to sum up, our mission is really to capture the full benefits of compounding by constructing a diversified portfolio of growing quality companies that we purchase at attractive prices and holding these investments for an extended period. We're not traders. We don't attempt to time the market. We attempt to value businesses rationally and hold those businesses for as long as they continue to be quality businesses. So we do balance valuation and growth, but the core of what we do is that we must have a quality business. Yaku, I'm going to jump into some questions now. These are questions submitted by the audience, and I think they're very telling questions. So the first question is, what kind of investor is best suited to a quality portfolio versus value or growth? I think the first thing would be an investor with a longer term time horizon. So as we've seen, as time goes by, quality does better and better. So if you're a longer term investor and you've got a longer term horizon, or your client has a longer term horizon, quality is a great investment. But we do see over rolling 5-year returns, quality has a great hit rate. Versus value or growth, I think those funds do require one to invest in a manager who's got proven skill in being able to time kind of value and growth investing. Or I think the person allocating the money has to have a certain amount of skill in knowing when to buy value or growth. But I think clearly, one would want to buy those kind of funds when they are struggling. A quality portfolio one doesn't have to time. So I think that's the kind of investor, someone who doesn't really want to make too many changes to the portfolio. What are suitable criteria to allocate to different styles, and is there an optimal weighting per style? Well, this is $1 million question. Of course, I'm a quality fund manager, so I would say allocate the most to quality. So it might be something like 50% to quality, 25% to growth, 25% to value. But as we know, things change, and especially when it comes to growth or value, and there is timing required of when to invest in these styles. But in terms of looking at who to invest and what kind of criteria to use, I think it would really be, is the portfolio manager who in each different style, is their fund diversified, or is it all concentrated in one sector? So any portfolio, whether it's quality or value or growth, if it's all concentrated in one sector, say if everything is in defensives, or everything is in staples, or everything is in technology, or everything is in energy companies, that is not going to be I think a prudent way to invest, regardless of your style. One needs to have diversification across different sectors, and then across different outcomes. I think to have 100% in a portfolio in defensive stocks isn't necessarily wise, because there are different outcomes. We can't build, again, portfolios for one single outcome. But one does also want to see that there's an adaptability, and that there is a sticking to a style. So, of course, if one opened a portfolio of, say, quality fund, and it was full of only marginal mining companies, then one would have to ask, is this really a quality fund? So is a portfolio manager sticking to his or her knitting? Now here's a great question: should Regulation 28 funds consider increasing their global allocation from 30 to 45%? And obviously this has to do with the recent limit changes around offshore investing. So where value can be identified internationally. I just want to flip to a slide here. This is a bit of a busy slide. It comes from Absa Securities, and this is local investors' foreign asset holdings. So the pink shading in the background is really the rand-dollar exchange rate. I would just focus on that and focus on the darker pink line, which is South African Unitrust CIS's funds offshore allocation. So we can see that the offshore allocation seems to follow the exchange rate. So as the exchange rate weakens, people put their money offshore, and there's also a bit of a correlation to what the offshore limits are. So by and large, as the offshore limit increases, the South African CIS funds, let's call them balance funds for now, although equity funds can do the same, people tend to put more and more money offshore. So I think this makes a lot of sense. I think if you can identify opportunities offshore, the opportunity set offshore is absolutely enormous. It's far greater than in South Africa, and if one can identify opportunities, one should invest your money offshore. However, the end client's requirements need to be taken into account, because obviously we are taking currency risk. So if the end client is highly dependent and really needs to fund South African rand expenses and liabilities, one first needs to cover those and be aware that a currency risk might cause problems in terms of funding expenses. So I would say, what are the client's expenses and liabilities in rands, and try and match any investments along those lines, so currency doesn't endanger the achievement of retirement objectives, if the client, of course, plans to retire in South Africa. Money in excess of that, I think, has to be allocated on an opportunity basis, and I do think it's more likely, given the wide universe offshore, that a significant portion of that money is going to end up offshore. So yes, it's opportunity based, and yes, the opportunity set offshore is far greater. What I'd like to put up is the next slide, is another kind of lens with which to look through that. People who've watched our previous Coffee with Counterpoints, we looked at the All Share Index, and we looked at see-through revenue exposures of all the companies listed on the JSE. And we could see, on a see-through basis, only 25% of money, and of course this is a market cap weighting, is generated in South Africa. So 75% of money listed, market cap weighted by companies in the All Share Index, is generated offshore already. So the question is, to put more money offshore, you first have to ask, how much money do I already have offshore if I, on a look-through basis, because many people are not aware they're already quite significantly exposed to offshore businesses. And I would argue, if one looks at the China exposure, now that China exposure really comes in the form of mining companies, Naspers, and in fact Richemont makes a lot of their money either in China or through the purchases by Chinese nationals of their products. And then we've got developed Europe, we've got North America. So I would say, how much sense does it make to have 10% in, say, Richemont, or 10% in a Naspers, or 40% in mining stocks, which are effectively offshore-driven companies. I mean, it's not there's not very much diversification in those kind of weightings. I would far prefer to reallocate money away from concentrated rand hedges listed on the JSE and diversify that money into, in my approach, it would be a diversified holding of quality offshore companies. So I think the first decision has to be made is, what do I effectively hold offshore in my South African listed stocks, and say I can diversify, so I can skew the return risk balance in my favor by reducing some of my holdings of rand hedges and putting those to work offshore in a diversified set of opportunities. So I think that is actually the more important question, is first be aware of your concentration risk. And we've seen that in Naspers not long ago. Naspers was 20-something% of the JSE All-Share Index, and now it's down to 7. I mean, it's lost half its value. So there's an example. And we know mining companies, it can be a bit hero to zero. At some stages, they're 40% of the All-Share Index, and then they can go down to 10. So I would use this opportunity of moving from 30 to 45 to diversify my rand hedge exposure. The second question is, with the world showing numerous signs of unpredictability, COVID, wars, the impact of sanctions, are our funds adaptable? And I think our funds have to be adaptable. But what I would stress is that trying to react when the crisis is already upon you, or when there's some war going on or there's sanctions, trying to react when they happen or after they've already happened is going to be perilous. One has to spend a lot of time on portfolio construction to protect the portfolio for unpredictable events. So what we spend time doing is looking at what are the correlations of our holdings and how exposed are they, how correlated are they. We don't want everything going wrong at once in our portfolio. And I think what this war has shown us is that geographical proximity is actually very important. So if you've got people who are posing significant risk to you, like Russia to Europe, and they are geographically close to you, that's a risk that one has to think quite carefully about. And when we look at the US, the US and places like Australia and South Africa, for that matter, are geographically isolated. So that has brought another kind of risk. A risk factor into the equation. But I think one really has to look quite carefully at how one is constructing the portfolio and ask a lot of what if questions. But absolutely, our funds are adaptable, and I think one has to have a mix of different types of equities across different sectors to cater for things. What I will say is that I've been doing a bit of reading just on the topic of war. And an interesting book that I'm continually reading is called The Lessons of History. And it was written by Nobel Prize winners. And the interesting thing is something like 90% of the time, there's been some war going on throughout, civilized history. So this is really the norm, as opposed to something that is out of the ordinary. And the second thing is, what I've been doing is reading about the experiences of great investors who've invested through wars. I mean, specifically John Templeton, who was a great global investor who started investing, prior to World War II. And in fact, he bought on the eve of World War II. He bought a whole lot of stocks. So the thing there is all those stocks quadrupled. So his lesson was, and among a couple of others, is never sell on war fears. And what we've seen now is there's been a significant snapback in European equities, despite this war continuing. So don't sell on war fears. That doesn't mean, I'm not saying go and pile into Russian stocks. I mean, I don't think piling into German stocks in the eve of World War II would have been a good idea either. But to indiscriminately sell equities around the world on war fears is not clever. If there's one thing I've learned, do not act in a panic. And another interesting one is don't sit in cash in a panic, because things like wars, crises, and all this in one way or another, end up being inflationary because governments act in crises. And how do they act? They spend money. They give people money. They spend money. And therefore, how do they get money? How do governments get money? They print money. Printing money is inflationary. The last place you want to be when inflation is on the horizon is sitting in cash, waiting for an entry point. So I would say sitting on cash in times of crises is going to be dangerous. Inflation is going to eat your money. And the best thing to do is to, in fact, invest in the time of crises. We know it's easier said than done, but I would say do not sit in cash. Sitting on cash before a crisis is extremely fortuitous. Very few people are clever enough to be able to do that. But going to cash in a crisis is not a great idea, especially if you're a fixed income investor in developed markets at very low yields, and yields are ticking up. You're going to get really hurt and probably suffer permanent capital loss when rates rise if you're sitting in developed market bonds. So our funds have to be adaptable, and I will stress it's very important to take a longer term view, but to also open one's eyes as to see what's happening in the real world. But I'd say the greater risk is that you try and trade too much and destroy the power of compounding. Yaku, I think for time we're looking pretty good. I don't know if there are any other questions. I mean, there were a few more questions. Are there any questions maybe in the question box?
There certainly is, Raymond. Thank you so much for taking us through your presentation. I think there certainly was some very thoughtful ideas that you've shared with the audience, and I think you've made a very strong case for making your global equity portfolio an anchor portfolio in somebody's investment portfolio in itself. One of the questions, there's two questions that came through on the Q&A box. I'm going to start with the second question first. And I think this question was, I know this question was posted is there something else that you want to share? I see that you've gone through the slide.
Sorry. What I've just done, Yaku, is I've just put up our, apologies to disrupt you there. I've just put up our current sector allocation for the fund. I wasn't sure if there was going to be time to, but this is just to show the diversification of the fund across various sectors. And I think the point to make, and it is a slide I have put up in the past, we have a decent weighting to what I would call investment companies, Berkshire and Brookfield being two of them. And this is really run by very sound capital allocators, quality investors themselves, who have access to opportunities in many ways that other listed investors don't. And I'll just stress that the tobacco holding, which is very defensive, and also that we are exposed to technology. If you look on the fact sheet, it says only 3%, but there's a broader technology weighting because things like Booking.com are not in classified as technology, but we are significantly underweight technology, which, as we know, has come under pressure as of late. And we do have holdings in materials and energy, so we are very well diversified across different sectors. Sorry, Yaku, to spring that one on you, but I thought I'd just put that up while we answer the questions.
Absolutely, no problem at all. Thanks, Ray. So the question that I wanted to ask, and this is more philosophical, and I know that you and I have spoken about this previously, about investment styles and more specifically on quality as a segment within South Africa. So the question is, in South Africa, and this question came up whilst we were talking about the 5, 10, and 20-year number returns of the various investment styles. In South Africa, are quality and value investment theses not used almost interchangeably? And I know that you've spoken about, the amount of companies that can be considered quality in the South African context, and that there really isn't enough of them going around to build a portfolio. So, is the one the opposite of the other, quality as opposed to value, or is there similarities? I know you mentioned earlier as well when we spoke about those quotes with Warren Buffett, that valuation is very important when it comes to quality as well. Are quality and value investment theses, are they opposites of each other, or do in a South African context, the question was, but I think you mentioned previously that there's not enough quality companies in South Africa as such to really build a portfolio. So let's talk quality versus value as opposed to only in South Africa, but the global context
Yeah.
too?
Yeah, I think, I mean, that's a very good question. I don't think quality and value are necessarily opposites. But remember, quality focuses on the business, whereas value focuses on valuing any business. So I think if you're fortunate enough great returns can be had if you can find a quality business selling at a cheap valuation. But by and large, it's very difficult to get that. So they're not opposites, but I think, in fact, when you look at quality and value portfolios, chances are that they're going to look very different. I think one sector is tobacco. I do believe tobacco companies are quality businesses, and they're looking very cheap. So that is one instance where, we're getting good businesses at cheaper valuations, and then scattered across the globe, there are opportunities, and that's what we focus a lot of effort on finding those opportunities. But they're not opposites, but they are going to look very different. In the South African context, of course, our market is a lot smaller than the MSCI world, so naturally there are going to be a lot more quality companies available for purchase in the wide world out there versus South Africa. I do think there are sufficient companies to purchase in South Africa that tick the box of quality. In our dividend equity fund is a quality fund. I will stress, though, however, that close to 30% of that fund is in direct offshore equities. So we've already filled up significantly on direct offshore equities. So we don't have to pick as many local equities, quality equities, but by and large, we have sufficient. There is sufficient choice, just sufficient choice. I use the word sufficient. It's not abundant choice, but it's sufficient choice to build a quality South African portfolio. The issue, of course, is in the South African context, is that other sectors such as mining, mainly is a massive sector in South Africa, and I wouldn't say the mining sector. It's very hard to find high quality mining companies. They're very unpredictable. The capital allocation track records of the companies is patchy. So, and with that being a huge portion of our market, especially if you compare it to various indices, it does create difficulties in terms of just from a relative performance. So if you compare it to the all share index, it can create difficulties. The other difficult one is, South African companies, most of the South African quality companies are SA Inc. companies. I'd say the vast majority reside in the SA Inc. bucket, and those companies are exposed to the vicissitudes of the South African economy and our structural challenges, our political risk, and it's very difficult for those companies to buck those trends. Some of those companies have done incredibly well to buck those trends, but many of those companies are richly valued, such as Clicks, I would say, done well to buck the trend. It's richly valued. It's a quality company. So that's the trickiness is that a lot of the South African quality companies are SA Inc. companies, and there are risks around there, so risks that need to be managed.
I think that's a great answer. Thank you for that, Raymond. We have run out of time. We've got a minute left. So in closing, Raymond, once again, thank you so much for sharing your thoughts with myself and the audience. Our next webinar will be on Wednesday, the 20th of April. It is set to be a coffee with Counterpoint. We will probably include a section on some feedback on the Payers and Growers portfolio, seeing to that has been quarter end, and there is some information in regards to the distributions that Ian and the rest of the Payers and Growers team will probably want to share with our audience. Then secondly, please take a minute, just a reminder that you completed the survey at the end of the session. And then once again, our funds are available on all the large platforms out there in South Africa, both the Dividend Equity Fund as well as the Global Equity dollar-based portfolio, as well as the feeder. Importantly, we have very recently loaded the Dividend Equity Fund on Easy Equities as a platform too. So for those of you accessing or using Easy Equities as a platform. The Dividend Equity Fund will be available there going forward. And then, importantly, if you've got any questions or comments or need assistance, you're welcome to reach out to us at Counterpoint at info@cpam.co.za. Or if you've got my personal details, you're more than welcome to give me a shout. And thank you so much for your time today. It was great having you with us. Thank you. Bye-bye.
Thank you, everyone. Thanks for attending.